I think we're kind of slowly gravitating towards lower inflation levels and a recession ultimately. But with the election in the fall, it kind of stretched things out. I think the Biden administration put all kinds of things through the government to try to keep the economy propped up and, help the Democrats, in the election. Didn't really help them, but now we're probably going to have payback, I would guess, in the first half of this coming year. So, but it doesn't really change anything because that's what I was expecting anyway. It's just kind of getting there a little more slowly. I think we are ultimately heading for a global bust still. I still expect that in 2025. I've said recently, I think what we're seeing in China, particularly with what you've seen in their interest rates and basically in deflation now, I think they're leading edge of this global bust. They are more levered than anyone else. They have more excesses than anyone else. They're running into more problems than anyone else right now because of their dependence on real estate. And I think it's just a matter of time before the rest of the world catches up with that. So that's probably going to be the big story of 2025. My whole thesis is that as long as we have a printing press, we're not defaulting on the debt. The issue with default, I think, is a 2030s problem because by then, I think we lose our printing press simply because inflation's way too high and you can't print when, printing just leads to even higher inflation and a bigger problem. So, but we're heading towards deflation, in my opinion, certainly have low inflation right now. So default is not an issue, in my opinion. Now, there may be a lot of rhetoric around it. There may be a lot of hand-wringing in the next year over that. But as you know, I'm predicting 20 trillion in new money coming out of the Fed in response to a global bust. Some of that will get moved up if we start running into, default risk. But I suspect the Biden administration is, and Yellen being part of that, they're just trying to make it difficult for Trump coming in. So my call has been for several years, we'll get this melt up and then, bust and bear. So bust refers to the economy, the financial system, and bear market accompanies that to the tune of maybe 70 or 80% downside. But, we aren't done with the melt up yet. So my view, in spite of so much bearishness coming in here very near term, you have people calling for a top here, saying, there's a lot of dangerous signs here, saying that we're seeing little breath. This correction of the last month has taken breath down. So there's a lot of people thinking we've seen the top. I don't believe that at all. I think everything I look at in my work says there's one last parabolic melt up into a top. So I think could be a first quarter thing, could stretch into the second quarter, but I think the next 3 or 4 months is going to be probably the steepest, biggest rally we've seen to date. So that gets you to, my target is 7,500 on the S&P, 25,000 on the NASDAQ, 55,000 on the Dow, 3,300 on the Russell. So the Russell from here is basically 50% upside. The Dow, the S&P, the NASDAQ, it's, 25 to 35%. But that's a lot of upside still to go. It'll come in a short period of time, in my opinion, but it'll be a lot of return. And then I think as we move towards the middle of the year, you're going to start realizing that this economy's losing a lot of steam. Europe and Asia obviously are already in trouble, and Canada is struggling. Australia's going to join that. So I think what we're going to see is as we move through the year is that we first go into a recession, and then recession turns into this global bust, which is my definition of that is that it's something the speed of a recession, but far worse than our normal recessions, kind of 2008-9 on steroids. As I say, the banking system in this country got some religion because of what happened in 2008, but banks around the world, Europe, Canada, Asia are in far worse shape now. And I think that's where you're going to see the biggest banking problems. But then because it's such a small world now, we're all intertwined. There's plenty of counterparty risk. It takes us down too. I don't know about bank failures other than regional. The real estate issue is going to probably come to the surface. But in terms of the big banks, I don't know that they get as bad as last time, but they certainly are not going to be going unscathed. If you look, even in 2008-9, it came back faster than the markets, but it did get hit initially. And I think that's what you can expect here. As I've said it, gold won't fall anywhere near as much as the equity market, in my opinion. Silver could. Silver's got, more volatility to it. But Gold, yeah, you probably see it down less and recover much sooner because the response to the bust will be massive money as well as government, massive fiscal response. But that massive money response means people will probably take that as a signal that we got to get into gold again. So I'm kind of using it. I still think there's a big run in gold and silver here in the next 6 months. Gold can get to 3,400 here before the bust and then could fall back anywhere from its breakout point at 2,100 to mid 2,500. So if you do a calculus on that, it's basically saying it can fall by somewhere probably between 25 and 30%, something like that, which would be, half or a third of what the equity market does. Silver, I'm calling for it to run to 29 to 75, and then at least back to here and probably back towards, the low 20s, mid 20s to low 20s. So that one's much more volatile. And then post bust, I think the precious metals are going to lead the pack. I mean, you will see, I think, gold get to 20,000. So if it gets back to, say, 2,100 and then rallies to 20,000, almost tenfold move. And silver, I think, can get to 500. So, if it moves back to the low 20s and moves to 500, you're talking about, a 25-fold move. So there's, I think, a huge future ahead in the precious metals, unlike the stock market, where I think the peak this next year, meaning that 7,500, if that's what it turns out to be on the S&P, the peak we see in this cycle is likely to stand for decades. In terms of the indexes, there'll be opportunities within the indexes, lots of groups that will do well, commodity producers, etc. But the indexes, I think, because of much higher interest rates next cycle, it'll squeeze PE multiples, etc. So first half of 2025, maybe even first quarter, those highs probably won't be seen again this decade and maybe not next decade. Whereas with gold and silver, obviously, I'm talking about, 20 plus fold increases in the metals. And obviously the miners will benefit greatly if that happens. I'm quite optimistic about what Trump is doing. He's coming in with a whole different understanding of Washington than he did, back in 2016. He's hitting the ground running, assuming most of his nominees get confirmed. I am optimistic that Doge will make some significant cuts in government and that we'll see a much more efficient government 2 and 3 years from now. The problem is the macro trumps that. I'm talking about something we haven't seen in 90 years. You can call the Great Depression part of it was a bust. We did see massive bank failures around the world, and we did see, an economy that was far below any recessionary norm. So you could call that what I'm calling here. This one isn't going to be a Great Depression. It's not stretched out over a decade because they will print that money pretty quickly. But the damage that's done in that 12 to 18 month time horizon that we're in a bust is massive. It not only is bigger than anything Trump can offset with, it also, if he were coming in a normal time, if this were even 4 years ago or 8 years ago, and he were doing this, I'd be super optimistic because it's very pro-capitalist agenda with, pretty big necessary deregulation, drill, baby, drill. So, taking advantage of the resources we have in this great land and cutting government, trying to reduce government's influence on the economy, which is usually a drag. Doing all of that, I think 8 years ago would have led to, people call the roaring 20s. I think he would have seen that. The problem is he's coming in at this time when we're approaching that bust. He doesn't want to just print money like crazy, but that's what's going to happen. It's not because of Trump. It's not because of Powell. Every central bank is going to have no choice if they want to save the system. You can sit back and say, well, we're not blowing up, we're not going to pump the system up again like we did and, the mistakes we made last cycle. And that's what Powell's telling you, right? He's pretty adamant he's not going back to that QE solution again. That's easy to say until you're staring in the face and the system is basically melting down. You're having a free fall in the financial system. They don't have a choice. It's the only tool they have where they can move quickly and stabilize the system. So whether it's 20 trillion or something less than that or more than that, that's my best guess of, kind of 4 times what we saw in the pandemic and every central bank around the world doing the same thing. That's way past anything Trump can do at the margin, right? I mean, that blows you out of the water. Central bank balance sheet of $875 billion back in 2008 before the response to the financial crisis. $875 billion was as big as we had gotten going back to 1913 when the Fed was put in place. And now we're talking, we got to 9 trillion during the pandemic, and we're talking maybe 30 trillion by the time we get through the bust. I think people need to understand, we throw around numbers and they may hear 20 or 30. I'm not sure they hear the trillion after that, right? I don't know that we really can wrap our heads around something like that. So as much as I'm very encouraged by Trump, I think he's very sincere in what he's trying to accomplish to bring America back to what it used to be and make us the world leader again. I think he will be successful in some ways with getting the military back in shape and bringing down the world wars, bringing down the Ukrainian situation, hopefully resolving something in the Middle East. All of that people should be optimistic about. But this is 80 years in the making. We've had cycle after cycle where the excesses build up into bigger levels, and then it takes a bigger response to bring it back down from those excesses. And in doing that, they overshoot, and then that creates an even bigger next cycle. So you've had this ratcheting up of excesses, imbalances, and monetary response. So now we're at levels where I think what comes at you bigger and faster, and the response is bigger and faster. And I think we're just at that point where it goes off the rails. It just goes through the roof on the upside in terms of the melt up in the market, and then excess build up. You get this crash in not just the markets, but in the financial system, and it requires a far bigger response than we've ever had. We're operating in nowhere land, basically unprecedented territory. So no policymaker has ever been here before, doesn't know what to do. And part of what Powell's trying to do sincerely in terms of saying we know the mistakes were made in the last 10 or 15 years, we're not going to repeat those. We're going to be more cautious. We're going to, do things more incrementally. Part of why we're going to have the bust is because of that, right? Because they're going to be slow to respond to what would normally take a quicker reaction. But they're going to say, no, we don't want to do that again. And in delaying it, you get an even bigger downside. And then ultimately, when they finally realize this thing's out of control, they have to come in with both feet. And we'll see numbers we've never seen before. So it's kind of almost inevitable that based on human behavior, you're fighting the last war, you're trying to overcompensate for what mistakes you made last time. And in so doing, you create even bigger problems. I think the rise in the 10-year rate was, as I said, directly a response to Trump getting elected and fears that, we were going to see more inflation, bigger deficits. That was pretty pervasive across Wall Street. That was kind of the popular narrative. I think what you had, people forget, we had a drop 5% down to 360 in the preceding 6 months. And so you went 5 to 360 back to 460, some maybe a 2/3 retracement type of thing. You have a lot of calls now, as happens when the tape moves that way, for 5, 6, 7% tenure. I have consistently said, didn't expect it honestly to get to 460, but I wasn't surprised by 440 or 450. But anyway, I've consistently said this is a counter trend move, and once it resolves, once it completes, we will see another leg down towards 3%, and ultimately, I think, 250. And I expect in the bust, the 10-year to go to 0% and short rates to go negative. And again, you can see that if you're coming out with, QE of 2020, that means you have to be buying debt, right? At the same time, the government's still going to be matching, probably not dollar for dollar, but they'll be doing a lot of fiscal expansion. So there'll be plenty of new debt, but they'll be monetizing all the debt. So it won't be a problem of saying, well, there's big supply out there and nobody wants to buy it. Fed will be the buyer of last resort because they're trying to get money into the system. And I say the Fed, but it'll be every central bank in the world doing the same thing. So I think we do have one lower low in rates. Everybody thought the 2020 lows, when 10-year got down to 0.4, thought that was the end. Everybody's consistent. I'd say 99.9% of pundits out there, analysts out there think we've seen historic low in rates and we won't go back there. We're going higher, not lower. I think we have one more leg down to new lows. That will be the secular peak in bonds, the secular low in rates. And then I think what follows that over the course of the next decade will be rates moving to secular new highs, meaning above the 1982 or 1981 peaks when long bond got to 15%, T-bills got to 21%. I think we'll exceed those by early next decade.